Corporate Finance OneNote Practice Problem. Future value of an annuity calculation. Don't leave profits solely to chance. Instead, use corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if you would like to, we're in the tab on the left-hand side. We're in the practice problems, and then down here in the 921 future value of an annuity section. Also note that if you have access to OneNote, you may want to take a look at the Immersive Reader function here. We have this item up top, and we might also have the transcripts down in the text files, which they have the practice problems. Those transcripts can be translated into other languages, as well as be read in both English and other languages, so they could complement a presentation video in that way. Going to be closing this back up top. Our information is going to be here. We're going to be working through that in the blue areas down below. We'll be taking a look at the future value of an annuity type of calculation. Scenario being, we're going to invest per period $12,000 for 9 years, and the percent is going to be the 7%. So if we were to do so, if we were able to invest then the 12% for 9 years at the 7% interest rate, then how much would we have? What would be the future value after that time period, after that annuity? That'll be our calculation. We'll do it a few different ways. One with the formula on the right-hand side. We'll also use the tables, and we may consider what it might look like if you were to use Excel to do the calculation, which we do have another presentation working it in Excel, and highly recommend using Excel or some other spreadsheet, such as Google Sheets, to do it that way as well. So we're going to break this formula down into its components first. So we have the future value of an annuity. P is going to be the 12,000 of investments that we're going to be making each period for the 9 years. 1 plus R to the N. R is going to be the percent that we will be using. N is the time frame or number of periods, which is going to be 9 in our case, minus 1 over R, also being the rate. We're going to break this down into like a kind of like a tax return kind of table format, where we'll have the outer column being P times this whole thing in the middle. Then we'll work the numerator in the inner columns of the table. Might be useful to kind of set up a table like this. Working with tables, useful to do in practical business settings. So we're going to take the 12,000, we'll put that out top. That's going to be P. Then we got the 1 plus R to the N, caret N minus 1. That's going to be this whole internal section here that we'll do the calculation for that. There's the 1. So 1 plus R, and then we're going to be picking up the R, which is going to be the 7%. So 100% plus 7%, or 1 plus 0.07 would be 107%, or 1.07. Be careful of the decimals and percentages, making sure that you're picking them up properly in your calculator. Then we're going to say that we're going to take that to the power of N, caret N, in say like Excel, caret N, or in a calculator. That's going to be the number of periods, in this case in years. We are calculating this in years. If it were in months, be careful that you're making sure that you have the proper periods that you're going to be covering and the interest rates lining up to the period that will be covered. So we're going to take that 107 caret to the power of 9. That will be about 1.838459. Rounded here, we are taking this from Excel, which is using the exact number. So once again, be careful of the rounding. Make sure you're taking that into consideration. And if you're working a test question, make sure that you are following the instructions as to the rounding that they request in it. So we have that. We're going to be subtracting out the 1. That'll take care of the numerator inside the brackets. So minus the 1, that's going to give us the 0.838459 about. So now we have then the numerator. Let's pick up the denominator, which is going to be R, which is the rate again, 7%. So if we got the numerator in one number, denominator by one number, we can then like divide them out. So the 0.838459 divided by the 7% is going to give us the 11.779887 about. Then we're going to multiply the 12,000 times that number that we just came to and get at the 143,735.83. So that's our future value calculation. Now note that if you just thought about this in terms of absolute dollars, we got the 12,000 that we're putting in times the 9, we got the 108, right? But then you're taking into consideration the 7%, and that's going to be the difference. So you kind of look at the difference between the amount of money being put in and the difference with the time value of money considering the rate. Also remember that that rate is something that we would have to determine within a particular circumstance. If it's an investment scenario, we're expecting that to basically be our average return on the investment. Let's now take a look at this in a different format, same information. We're basically going to create a running balance this time. This is something that you don't often see because people basically just put this into a system, into a calculation, and come up with the result. But it's really useful to see a running balance. And if you have more complex scenarios, then this could be useful in those more complex types of scenarios as well. It can be tedious to be done by hand, but if you have something like Excel or any other kind of spreadsheet, typically, it will not be a difficult thing to do. So let's take a look at it. We're going to say the periods. We have the periods on the left-hand side. So period 1, let's imagine that we're putting in our annuity calculations. It's going to be at that 12,000. So 12,000 at period 1, we're just going to say is going to be equal to the 12,000 after that time period. Let's then take that 12,000 and imagine that we're going to be calculating the interest on it. So we're then going to be taking the 12,000 times the 0.07 or 7%. That's going to give us our 840. If I take that 840 plus the next 12,000 that we're putting in period 2, in this case year 2, so plus the 12,000 here, that would be 12,840 plus the prior 12,000, this one right here. So this plus the 840 plus the 12,000 there plus the prior 12,000 is going to be then our 24,840. Let's do that again now. And notice this can be easily done within Excel. You can do this running balance. I highly recommend going to Excel and practicing it because it's a quite useful calculation. Now we're at the 24,840. Then we're going to say times, and let's take times 0.07. So that's going to give us our interest of about 1738.80. It's rounded here now. And then I'm going to put in another 12,000 plus another 12,000. And then we also were at before the 24,840 plus the 24,840, 24,840. Now we're at the 38,578.80 about. Then if we go down and we're going to say, all right, well then if I do this again, I'm just going to continue on this process and say, all right, well then I'm going to say that times the 0.07. Now the interest is growing. This is exciting because like the interest is getting larger as we do each one. And so we're going to take that, and then we're going to add the 12,000. We're going to put in again another 12,000, and then there's that. And then we're going to add what we had before, which is the 38. There's that 38 right there, the 38,578.8. So this is growing faster. This is growing faster. And then if we keep doing this, of course, now we're on period 5, and like, look at that, going up and up. And we're going to say 0.07. Now we're at the interest is at the 3730 plus the 12,000 we're going to put in for our annuity, another 12,000 plus where we were at before, that 53,53279.32. Now we're at 69,008. This is looking good. We're going to take that and do it one more time, and then I'll stop this. We're going to say times 0.07. This is good times. Now we're at the 4,831 about. Plus the 12,000 there, 12,000, and then plus what we had before, which was that 69,008.87. So we got the 85,839. So you can see this is a tedious calculation, although quite fun, obviously. But in Excel, easy to do because you got the autofill function and something that is worthwhile to do because then you can actually kind of see the growth take place as it's basically compounding. We get to the 143,735.86, tying out to the 143,735.86 we got to up top in that format as well. If we put this into, say, Excel, and like similar to a financial calculator, this is the magic way. This is the magic way it happens, where most people will do and not fully really understand probably what is going on. They just know it's an annuity, and that's what they're going to put in there. So we're going to say the rate then would be the 7%. Notice that we're talking about in a yearly rate here because our periods are going to be in years. The number of periods is going to be that 9 in this case. Once again, periods are going to be in years in our problem here. And then the payments would be then the 12,000. The payment then being used in our calculation because we're doing an annuity. If it were not an annuity, we would skip the payment and be using the present value. That then, once again, gets us to the 143,735.86, the magic way. And then we can do also the tables, table time. Let's do it in the table time way. Same thing, but this time using the tables, thus the name table time. So we got the 7% at the 9 periods, 9 years, 7 and 9. So let's go down here. 7%, 9 is going to be at the, let's see, that's going to be the 11 11.978, so 11.978, and then we can just take that 12,000 times the 11.978. We would get the 143,736, slightly different than the 143,735 because the table only went out 3 digits. I believe it went out 3 digits here. And if we were to calculate the table and calculate it more than 3 digits out, I think we did that up top, it would be something like, that would be this number, 143,735.86 divided by the 12,000, which you would think would be 11.9779887, and they gave us 11.978, resulting in a slight difference due to rounding. Let's do it again, same kind of problem, different set of numbers. We're going to say, what if we invest 11,000 for 35 years, and we're estimating that the return is going to be the 9%. So once again, even set of payments that we're going to be putting in place for a long period of time now, the 35 years, and we're thinking that we have an average rate of return, or the return that we're going to be using over that time period is going to be the 9%. We have the formula up top, once again, P times this whole thing, P being the payments that we're going to be putting in, that's the 11,000, times 1 plus R, R's being the rate, 9%, to the periods, in this case, periods being years, of 35 minus 1 divided by R, once again, 9%. Let's do that first in our kind of mathematical calculation where we're going to put this into a table type of format, breaking this algebraic problem down into a table, which you probably don't see all the time, but a really good way to do it, I think. We're going to take the 11,000, which is P, and then we're going to be bringing out the numerator and denominator in the inner column, and then any more nuance in the numerator, because that's a long part in the inner column here. So we're going to then take the 1 plus R to the caret N is our next calculation. There's the 1 plus the R, which is 9%, as we saw up top, 9% R, 1 or 100% plus 9%, or 0.09 would be 109% or 1.09. Be careful of decimals and percents. We're going to then take that to the caret, or to the power of the number of years, that being 35, 109% caret 35 is going to give us about, be careful of rounding, 20.41396.8, and then we're going to take that, and we're going to take that. That's going to be, we're here now. We just did this calculation, minus 1. So we're going to take that and subtract out 1. That gives us the 19.413968 about, be careful of the rounding. That's the entire numerator. The denominator being R, 9%. So dividing that then by R, 9%, that's going to give us about 215.710757 about. Now we can multiply the 11,000 times that thing that we just calculated. That's going to give us the 2,372,818.30. So that means, once again, if we put the 11,000 for 35 years at that 9%, that's what we come up with. If we were thinking about that without any kind of rate, it would be the 11,000 times 35. So there we go. So notice it's growing, of course, because of the compounding with the interest rate a lot. So we're down here at the 2 million, and so, you know, hopefully that would be enough to retire on now, but with the wave of inflation that's expected, I don't know anymore if that would do it. But yeah, it's probably, I don't know, in any case. Future value of an annuity, let's take a look at it as if we were going to calculate it in the tables now. And this is going to be our running balance. So for example, if we put in like the 11,000 in the first period, then we're going to say that that's just simply going to be the 11,000. And then if we took that 11,000 and said times the 0.09, that's going to be the 990 plus the original 11,000, or the next 11,000 we're going to put in, 11,000. And then the original 11,000, because we're putting in another 11,000, that's going to give us the 22,990. If we took that and then looked at period 3 and say, let's multiply that times 0.09, and that's going to give us the return of 2,069 about, plus we're going to put in another 11,000, and then plus we had before this 22,990. That gets us at the 36,059.10. If we took that and multiplied it times 0.09, then it starts to grow, and we're like, this is gonna be way more than I thought. I'm gonna be able to live. I can live. So that's on my retirement. So 3,241, and then plus the 11,000 plus what we had before, which is the 36,059.1. 5304. Let's do it one more time. Watching it grow, just watching it grow. Don't need to do nothing. Just sit and watch it grow. We got then the 4527 plus the 11,000 plus where we were at before, 50304.42. That gives us the 65. Notice for 35 years, this would be a tedious calculation, but with Excel, because we got the autofill calculation, we can do it quite easily, and we have done it easily, and you can go check it out if you want to. And you can see how it's growing here, and you can see basically then where we're getting to, which in the end result. So you can see kind of the growth that's going to be taking place on a step-by-step basis. Also know that this calculation could be useful if you think about a scenario where you think that the rates are going to change over time, right? Then you can do your running balance and you could change the rate. If you think inflation is going to kick in, you don't think you're going to get the rate of return that you're going to get at one point or another, or if you think you're going to be putting more payments in at some point as you grow and generate more revenue, then your calculation can change. And if you do a running balance calculation, you can take into consideration. You can also do some kind of a running balance portion and an annuity portion. You might say, well, for 10 years, I'm going to do this scenario, and then I think things are going to change. You know, the economy is going to tank or something like that, and I'm going to, then have to account for that for the next year, and then maybe it'll, you might do some more complex kind of scenarios such as that, which you cannot do if you just do one annuity payment, because clearly you are then assuming that these things are standard and fixed. Okay, so let's go on back down, and let's do this with Excel. If we did this with Excel, we can say, all right, let's put this into our future value thing here. So future value of the rate, which would be the 9% number of periods, which is going to be the 35 periods in years in our practice problem here. And then the payment then is going to be the 11,000. Using the payment this time, because it is an annuity calculation, would once again get us to that 2,372,818.30. And then you can do it with the table time. Same thing, table time. So now we're going to use our annuity tables, making sure that we're picking up the proper table, 9%, 35 years. Not all tables go down to 35 years. That's one of the difficulties or problems with the tables if you're going out that far. But we're saying 9%. This one does, I think. That's why we used it. 35 is way down here, and that's going to be the 215,711. So 215.711, we take that 11,000 times the 215.711. We get, once again, almost or close to what we got before, that being the 2,372,821. It's not quite the same. Why? Because of rounding. Tables rounded only to 3 to 4 digits here at the 215,711. If we did the calculation ourselves, taking it more than 3 digits out, it would be something more like the 215.7107547. Therefore, rounding is going to be a factor, although probably not one that would affect a normal decision making due to it being immaterial, but one which, especially with larger numbers, can be significant enough for test questions to then differentiate multiple choice answers and force you to use one method or another. Be careful of that.